Well, hello on this chilly day. Welcome to Money Markets and More with me, Dominic Frisby. And today we consider the January indicators. Things are looking bright for the bulls. As January goes, so goes the rest of the year, is the wisdom. And January is going rather well so far here in Britain. The FTSE 100 has broken out to all-time highs. In the States, the S&P 500 is up 5% for the month. And with all this in mind, I wanted to share quite a cool stat I read with you. I learnt it off JC Portents at All Star Charts. So, if you get a Santa Claus rally, that would be a rally in the S&P 500 in the week between the 23rd of December and the 4th of January. And then after that you get a positive first 5 days of the year, and then you get a positive January. You have what Portents calls the Trifecta. And it's worth noting, by the way, there was no Santa Claus rally in the years going into the big crashes in 2000 and 2008. Maybe coincidence, I don't know. So it's not quite the end of January. There's a couple of days to go, but barring a major turn down in the next couple of days, it looks like we have got Portents' Trifecta. We got a 1% just under Santa Claus rally. Doesn't sound like much, but Portents argues it's more than 3 times the historical returns for all the other 7-day periods throughout the year. I'm not quite sure what he means by that, but anyway, that's what he said. And then we got another 1.5% rally in the first 5 days of 2023. This is US stocks we're talking about. And then January itself looks pretty strong. Assuming there's not much change over the next couple of days, it's going to be up about 5% overall. So I'm just going to run across this road. Here's the statistic that's going to get the S&P bulls salivating. Since 1950, whenever the S&P 500 has completed the trifecta, coming off a down year, the stock market has never been down, and it's up 27% on average, which is more than 3 times the average annual rate of return for the S&P 500. 27%, I'll take that. You don't get trifectas very often, by the way. So, number 2, more bull food. The US presidential cycle. We're coming into the 3rd year of the 4-year US presidential cycle, and that's the year when the powers that be try to get everything looking hunky-dory in time for the next election. And these are normally very good years for stocks. So if you don't believe me, there's a Charles Schwab researcher called Lee Bohl who's analysed market data since 1933, and he's found that the strongest market gains came in the 3rd year of the presidency, and this is with alarming consistency. The average returns in each year of the presidential cycle between 1933 and 2015 are: year after the election 6.7%, second year 5.8%, third year 16%, fourth year 6.7%. And then remember 2019, Donald Trump's 3rd year, that got a 27% rally, and that would carry those averages I just mentioned even higher. Between 1933 and 2022, the stock market saw gains in roughly 70% of calendar years. But in year 3 of the presidential cycle, that rises to over 80%. I like 80% probability rates. So the portents then are very good. But the economy, the war on Ukraine, China, inflation, Russia, political uncertainty, political division, social unrest, the bear market, all of that stuff. Markets don't care about that stuff, except when they do. But they're all tired narratives now, and so they're all priced in. For now, the easiest direction of travel is up. The trend is your friend, as they say. So here's one final bit of bull food for you. The S&P 500 peaked in early 2022 and it trended lower for the year with occasional rallies. But it's just broken above its falling trend line. You can see that by the chart here. I've posted the chart here. Now, that kind of signal may not mean much in isolation, but coupled with everything else, you've got to say that things are looking up. And trend followers will also have observed that all the short and intermediate term moving averages over 7 days, 21 days, 55 days, even 144 days, they are sloping up. The S&P 500 has broken above its 200-day moving average as well. And so it won't be long before that turns up as well. In other words, we have a new uptrend in place on most time frames. Trends are powerful things. You might have heard me mention that once or twice. So, whether it's the technicals, the cycles, the historical patterns, there are lots of reasons to be bullish for the year ahead. And after the year we've just had, it's hard to feel that way. It's far easier to be stuck in a negative mindset, as perhaps we were too slow to get into a negative mindset at the onset of the bear market. But I'm only reporting on what I'm seeing, and I think it looks bullish. On the other hand, it might be worth pointing out that we're still below where we were in early December, and that, as always, there is a lot that can go wrong in the world. But for now, Monday morning, and I'm feeling bullish. Thank you very much for watching. I'll be back with another video very soon. Until then, goodbye. Subscribe to my Substack.